Two major market tests are arriving almost simultaneously, and how they land could define the next leg of this rally. Wall Street has been on a solid run, but that advance now faces a near-term reckoning. The monthly US jobs report and a wave of earnings from major technology companies tied to artificial intelligence are both due in close succession. Together, they represent two of the most closely watched signals in markets right now. Start with the jobs report. When hiring comes in stronger than expected, bond yields tend to rise. That happens because traders read a robust labor market as a reason for the Federal Reserve to keep interest rates higher for longer. And higher rates matter. They make borrowing more expensive, and they tend to weigh on the value of growth-oriented stocks. So a strong number is not straightforwardly good news for equities. A softer number, on the other hand, could revive hopes that the Fed might cut rates later this year. That would likely be welcomed by stock investors. Then comes the earnings wave from large technology companies closely linked to AI investment. These stocks have carried an outsized share of the market's gains in recent months. That concentration creates real risk. If results disappoint, or if company guidance falls short of what analysts were expecting, the selling could spread quickly across broader indexes. But strong results would send a different message entirely. They would reinforce the idea that the enormous amount of capital being spent on AI infrastructure is actually showing up as real revenue growth. Running through both storylines is inflation. Price pressures have proven stickier than the Federal Reserve, or most investors, expected. Every piece of economic data is now examined for clues about whether inflation is genuinely cooling. If hiring stays strong and corporate earnings suggest that consumers and businesses are still spending freely, markets may have to accept that the road back to lower interest rates is longer than hoped. That combination, labor data, tech earnings, and the inflation question, arriving within a short window, gives this period unusual significance. Investors have grown comfortable with an optimistic tone in recent trading. The data arriving now will either validate that comfort or give markets a reason to reconsider. The practical takeaway here is straightforward. Investors holding positions in growth stocks or AI-linked technology names should pay close attention to two things when results come out. Not just whether earnings beat expectations, but what company guidance says about future spending and demand. That forward-looking language often matters more than the headline number, and in the current environment, it will be read closely by everyone in the market. This briefing is brought to you by First Financial News. Clear, daily coverage of the economy and markets at firstfinancialnews.com.